why many fundamental and technical indicators are showing that the market was supposed to crash long time ago. And here we are. Market steer near its all-time high. So what is going on? Are we ever going to see a crash in the first place? Well, let's find out. From technical standpoint, let's take a look at the S&P 500 adjusted for inflation for the past 100 years. Adjusted for inflation makes a perfect sense because that's exactly what you would end up paying in the real world. The price fluctuations falls perfectly into this 100 years data positive channel. It is reasonable to conclude if you are buying at the bottom of this channel, you are buying at the undervalued market. On the flip side, if you are buying at the top of this channel, you are buying at overvalued market. If you park your money at the wrong time of the cycle, you can wait decades to see some profit or at least break even. If you would bought at 1929, just before that massive crash, you would lose 86% of your investment in the next 3 years. Additionally, it would take 30 years to just break even adjusted for inflation. Similarly, if you would bought at 1969 prior to another crash, you would lose 70% of your initial investment in the next 13 years. And you would have to wait 24 years to just break even once again, adjusted for inflation. And lastly, dot-com bubble. If you would bought at the peak of 2000s, you would lose 60% in the next 9 years and you would break even in the next 15 years, of course, adjusted for inflation. So we can see if you pull the trigger at the wrong time, you may wait decades to at least break even. So why the market is not crashing yet? Well, two things: inflation and earnings. Corporate profits still look strong, but do not forget, even if the company produces strong earnings, it does not mean it's not overvalued. S&P 500 is a collection of 500 biggest companies by market cap in the United States. The total market cap is around $60 trillion. Nvidia alone is the biggest company in the world with market cap of $4.6 trillion and it accounts roughly 8% of entire index, followed by Microsoft with $3.85 trillion market capitalization that accounts 7% of the index, followed by Apple with $3 trillion market cap that accounts 6% of the index. So only 3 top companies in S&P 500 accounts of more than 21% of the entire index. That is insane. Yes, they may have promising future with AI, with chips, but once again, it does not mean they are not overvalued. Nvidia PE ratio is at 54, which means for every $54 you invest, you would receive only $1 in profit. This equivalent to annual rate of return would be less than 2%. You may be better off just buying treasuries. Microsoft PE ratio 33 and Apple PE ratio is at 30. So entire S&P 500 index has PE ratio is roughly at 30. The only time it has been higher is during 2020 COVID crash, 2008 financial crisis and 2000 dot-com bubble. Notice right now the median historic S&P 500 PE ratio is at 15. So you do not have to be a rocket scientist to figure it out that market is indeed overvalued. That being said, earnings in these tech companies are not true earnings. Primarily, these earnings are being driven by inflation. The Federal Reserve has the power to create digital dollars through. It does this by adding money to the reserve accounts that commercial banks hold at the Fed. The money did not exist before, it's created out of the thin air, but within the Fed's legal authority. The Fed then buys financial assets, usually US Treasury bonds or mortgage-backed securities from banks and other financial institutions, and injects liquidity into this system. Then most of that liquidity will end up in equity, real estate and even bond market, inflating the prices artificially.
Simply flooded the system with money.
Yes, we did.
That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally, and we do that by buying treasury bills or bonds or other government-guaranteed securities, and that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve banks.
In a simple terms, let's say there are $10 in the economy. That's a scarcity. But what if the central banks printed additional $10? Then the first $10 will turn into $20. There was no production growth, nothing at all, and yet central bank created inflation out of the thin air by devaluating currency. That's why even better indicator than S&P 500 ratio would be Shiller PE, because it is adjusted for inflation. The Shiller PE ratio, also called as a CAP ratio, cyclically adjusted price to earning ratio, is a stock market valuation measure developed by economist Robert Shiller. The Shiller PE compares the current price of S&P 500 to the average inflation-adjusted earnings of the past 10 years. Currently, the Shiller PE is almost at 40, even higher than it was prior to the biggest crash of them all of 1930s Great Depression, with the market collapse by almost 90%. Back then, Shiller PE ratio was at 31. The only time when Shiller PE ratio was higher than it is today, that would be 2000 dot-com bubble. Back then, Shiller PE was as high as 43, and shortly, market crashed by 50%. Now let's ask a question. Is the stock market gone up so much because the economy is so productive, or maybe because the Federal Reserve inflated a bubble? Another great indicator that supports this bubble economy thesis would be Buffett indicator. The Buffett indicator expresses the value of the US stock market in terms of the size of US economy. If the stock market value is growing much faster than actual economy, then it may be a bubble. Calculation is very simple. Total US stock market value $65 trillion. Annualized GDP $30 trillion. Buffett indicator $65 trillion divided by $30 trillion equals to 217%. The current ratio of 217% is approximately 117%, or about 2.2 standard deviation above the historic trend line, suggesting that stock market is strongly overvalued relatively to GDP. US unemployment, at least on the paper, looks strong. Currently it is at 4.3%, but do not be fooled by these numbers. If they would measure unemployment rate at the same way they did a few decades ago, these numbers would look a lot worse. Let's pretend they're not moving the goalpost to rig the game. Still, recent headlines. Microsoft announced more than 6,000 job cuts, about 3% of its workforce across multiple divisions. Amazon plans to eliminate around 14,000 corporate jobs, or 4% of its workforce, as it restructures towards AI. UPS announced to cut more than 20,000 jobs, or over 4% of its workforce, tied to reducing reliance on Amazon deliveries and automotive operation. The list can go on and on. As we can see from this chart, there is a strong correlation between S&P 500 and total job market opening. The total job opening hits 3 years new low, while S&P 500 makes new highs. As of latest data, there is less new jobs opening right now than it was back during 2020 COVID crash. Prices may fly high, but eventually, like always, market will realize its true intrinsic value. Additionally, government has been shut down since October 1st, 2025. As of early November 2025, the shutdown has become the longest in US history, surpassing the previous records. Although about 1.5 million civilian federal employees across the country are gone without pay, according to Bipartisan Policy Center. They all have credit cards to pay, they all have bills to pay, loans to pay, mortgages to pay, so on and on. Because of this shutdown, the Treasury account has risen to more than $1 trillion as it being pulled out of the banking system, creating a tightening or a squeeze on financial system. This is an underlying plumbing in the financial system that makes liquidity move. As long as the government shutdown continues, expect banks to go overnight the repo market and placing treasuries and mortgage-backed securities as collateral in exchange for quick cash. Since late October, the repo market spiked and Fed injected more than $100 billion into the system, which means banks are desperate for quick cash. These are the highest daily liquidity needs in almost 5 years. Repo market only spikes when banks are short on cash. That means liquidity is tighter than it looks. This is a perfect example when liquidity dries up, market contracts. As long as these federal workers, 1.5 million or so, do not get paid tens of billions of dollars, this money do not go into the system. That means credit cards are not being paid, mortgages are not being paid, loans not being paid, and who is getting hurt? Yes, ordinary people are getting hurt, but so are the banks. They will continue borrowing more and more money, pledge more treasuries and mortgage-backed securities to meet their obligations. But at some point, there is a breaking point. Liquidity in the equity market is getting squeezed. If it will get squeezed more and more, there is a good chance this market will come down.